Good morning, everyone. Thanks for attending our weekly research morning call. For today, we have a few result and stock updates, followed by the Euro technical analysis and Singapore weekly. So without further ado, I'll hand over to Max to present on Amazon, Apple, and Semicon. Max, please.
Thanks, Mel, and good morning, everyone. We released our Amazon report on the first quarter earnings last week, and overall the results were within our expectations, with the first quarter revenue and PATMI at 23 and 25% of our full year forecast. So jumping straight into the positive, firstly is that Amazon managed to beat their revenue guidance. Previous slide. Yeah, sorry. Yeah, so for the first positive is that Amazon managed to beat their revenue guidance, with the revenue growing by 9.4% to $127.4 billion, which was above the guidance of the top end of the guidance of $126 billion. The international segment was up by 1% year on year, which was its first positive growth since the fourth quarter of 2021, and this was attributed to the easing inflation seen in the European region. The company's advertising revenue, which is part of their retail business, grew by 21% year on year, or about 23% in constant currency basis. And this reflects that there's a continuous strong demand for the company's digital advertising business. For AWS, it increased by 16% year on year, which was in line with the company guidance, despite the fact that they continue to see customers' cloud spending optimization efforts. For the second positive, Amazon also improved in terms of margins. The operating income for the quarter was about $4.8 billion, which signifies the 30% year-on-year growth, and it is also above the top-end company guidance of $4 billion. The North America segment posted its first operating income since the fourth quarter of 2021, with at about $900 million, or about 1.2% margins, and the international segment also improved in terms of their margins as well, with their negative margins declining to negative 4.3%, which is an improvement from the negative 6.5% from the fourth quarter of last year. So both North America and international segment are Amazon's retail business, and we can see that the retail business has improved in terms of margins, but this was partially offset by the margins contraction in AWS by about 30 basis points quarter on quarter. For the negatives, however, Amazon is expecting a further growth deceleration for AWS heading into the second quarter. So the company estimates that the April year-on-year revenue growth for AWS is about 5% lower than that of the first quarter, which would imply an 11% growth rate for the second quarter. However, it still reiterated that its new customer pipeline remains strong, and that its existing customers are extending their expiring contracts and will continue to engage with AWS moving forward. Next slide. Moving on to the outlook, Amazon has guided for the second quarter revenue to be between $127 and $133 billion, which signifies a growth of 5 to 10% year on year. And then towards the end of the earnings call, Amazon has said that it will incur lower capex for FY23 compared to the $59 billion spent in FY22. And this lower capex will mainly come from spending cuts on building, fulfillment, and transportation networks. But at the same time, the company will also reallocate some of those budgets over to AWS to build infrastructure for generative AI and large language models capability. So for our valuation, we maintain our accumulated rating with a raised target price of $120 US, using a WACC of 6.4% and terminal growth of 5%. And the TP is increased to take into account the lower capex spending plans by the company. That's for Amazon. Now moving on to Apple. We also published our reports this morning on the second quarter results. So for Apple, the results were also within our expectations, with the first half revenue and PATMI at 53 and 54% of our full year forecast. For the first positive, Apple also beat their revenue guidance, and although the revenue dipped by 2.5% year on year, it is still better than the 5% decline that was guided by the company towards the end of the first quarter. And this performance was due to better than expected iPhone sales, which grew by 2% year-on-year. And this was mainly driven by the strong growth in emerging markets, with revenue doubling in countries like India, Indonesia, Turkey, and UAE. For the other products, they were roughly in line with the guidance, such as Mac and iPad sales. They were down by 31% and 30% respectively. And this was attributed to challenging comparison from last year, because last year they launched the M1 MacBook Pro 14-inch and as well as the M1 iPad Air. And it is also because of FX headwinds as well as the macro conditions too. For services, it continued its upward growth trajectory. So it increased by about 6% or about 11% in constant currency basis. For the second positive, Apple also experienced a sequential gross margin expansion. So gross margin for the quarter expanded by 130 basis points to 44.3%. And this was mainly driven by the 20 basis points quarter-on-quarter gross margin expansion in services, but was then partially offset by the 30 basis point contraction from their product side. But however, this still result in the overall gross margin expansion for the quarter. And this is because the favorable revenue mix towards services, which makes up about 22% of the total revenue, compared to the 18% in the first quarter. For the negatives, however, Apple is still expecting a revenue contraction to continue in the quarter of this year. So they said that the third quarter year-on-year revenue performance will be similar to the second quarter, which implies a 2 to 3% decline. And FX is expected to post headwind of about 4%. However, despite this, services is still expected to continue its upward trajectory and growing by 6% year-on-year. Next slide. Yeah, for outlook, as I mentioned just now, they are guiding for revenue contraction to continue in the third quarter. And although they are guiding for services growth, they are still expecting challenges in their digital advertising as well as mobile gaming because of the macroeconomic conditions. Gross margin is expected to stay flat quarter-on-quarter, and despite the fact that they're going to face a seasonally weaker sales, gross margin is able to sustain at the current level, and this is because the company is seeing lower FX headwinds, and at the same time they are also seeing declining prices in components. For our evaluation, we downgrade to accumulate rating with a lower target price of $183, using a WACC of 6.5% and terminal growth rate of 3%. We expect FY23 revenue to contract relative to FY22, and this is because we don't think that the revenue is likely to grow in the second half, because customers are likely to defer their iPhone purchases until the expected iPhone 15 release this year, which we think will create pent-up demand and ultimately results in positive growth returning in FY24. So that's all for Apple. That's all for the individual companies that I have. So this is a slide summarizing the year-on-year performance of major semicon companies that announced the results for the first quarter. And just as a disclaimer, we don't cover these companies. So we can see that overall Semicon is still experiencing revenue contraction, and as well as in earnings as well. But I guess you can see that ASML is the outlier. You can see that they're still experiencing very strong revenue growth and earnings growth as well. So I think I'll discuss ASML first. So ASML is able to post such strong results mainly because they are the dominant or if not the only player in lithography machines, which is the essential equipment for the semicon industry to advance their technology. So because the other semicon companies are trying to ramp up their next generation products, the machines produced by ASML is going to be more important than ever. So, and in fact, ASML says that the demand for the machines is still outpacing the ability to supply, and therefore they are not really affected by the capex cutting initiatives done by the other semicon companies. So moving to the more consumer side of things, AMD and Intel, we can see that both are experiencing revenue and earnings contraction, but I guess Intel is performing worse than AMD. But however, both companies share the same outlook, whereby they think that the PC market will contract this year. And in fact, AMD is expecting a 10% decline in PC sales for 2023. And then both are also expecting that the second half revenue will be better compared to the first half. And this is mainly because of two reasons. Firstly, they believe that the channel inventory glut will clear out by the second half of this year, by the end of second quarter, and therefore they don't need to undership their product as much in the second quarter. And then there's also the fact that both companies have product roadmaps whereby they are expecting to ramp up their next generation products towards the end of towards the end of this year, sorry. So yeah, for Qualcomm, they represent the smartphone industry. So the smartphone industry is kind of a similar story to the PC market, and it is expected to contract this year as well. So Qualcomm has actually said that they didn't see any evidence of the market recovery because of the China reopening. So and for Qualcomm specifically, they also provided a conservative guidance for the second half, as they said that they don't think that the second half will be much better than the first half because of what they refer to as the timing purchase of their modem-only customers, which we know is the largest smartphone maker in the US. So yeah, both PC and smartphone market is expected to go down, and this is also repeated by TSMC as well. So yeah, but for TSMC, they are expecting the second half revenue to be better than the first half, because of the product launch of one of the biggest customers later this year. So yeah, that is the quick summary of the Semicon companies that announced the results. Now I hand over my time to Ambrish to talk about Microsoft. Thank you.
Thank you, Max, and good morning, everyone. So moving on to Microsoft, we released its third quarter report with the title Azure is its primary growth engine. So overall, the third quarter results, they were within our expectations, with 9 months 2023 revenue and PATMI at about 75% and 73% of our full year forecasts. So in third quarter, total revenue grew by about 7% to 52.9 billion. And this was mainly driven by its cloud business, and despite a 3% foreign exchange headwinds. So moving on to the positives, Azure remains the primary growth driver for Microsoft. So Azure, it's basically Microsoft's cloud service, and it's the second largest cloud service provider below, and the largest provider is Amazon. So in the earnings call, management highlighted that Azure revenue, it grew by about 31% year over year in the third quarter, and this was in line with the company's guidance range, and mainly driven by the digital transformation trends as the companies they digitize their operations to minimize their costs. So the strength in Azure, it helped Microsoft to drive growth in its intelligent cloud revenue, which grew by about 16% in the third quarter. So moving on to our second positive, the demand for Office 365, which comes under productivity and business processes segment, it remains strong. So the Office 365 commercial revenue, management said that it grew by about 18% year over year. And this was mainly because of two reasons. Its paid subscribers, they grew by about 11% year over year to 382 million. And this was mainly because of rising need to manage tasks and workflows, mainly by front-end workers. And also because of the growth in revenue per user, as it witnessed continued momentum in its premium E5 license. So moving on to the negative, Microsoft, it witnessed decelerating growth in its Windows OEM revenue, which fell by about 28% year over year in the third quarter, and mainly because of the weak personal computer sales. So Windows OEM revenue, it basically Microsoft generates via PC manufacturers like Dell and HP who install Windows software on their machines. So moving on to the outlook for the fourth quarter of 2023. Next slide, please. Microsoft said that it expects its revenue growth to be between 6 to 8% in the fourth quarter, which is about $55 billion. And Microsoft, it's expecting enterprises to optimize further into the fourth quarter. And as a result, its Azure revenue growth, it's expected to further decelerate to about 26 to 27%. in the fourth quarter. And it expects a foreign exchange headwind of about 2% on its total revenue growth. And Windows OEM revenue, it's expected to further decline by about low to mid 20% range. And lastly, management, it also highlighted that its capex in the fourth quarter, it's expected to be significant. It expected to be higher as compared to the third quarter. And this is mainly because of its investments into the AI. However, management did note that in the near term, AI products are not should not significantly contribute to its top line growth, but it's still witnessing a promising early trends for its Bing and its Azure OpenAI Scout service platform. So in terms of its valuation, we have downgraded Microsoft to accumulate from buy. And this is mainly because the stock price has run up in the recent trading days. And we have increased its target price to $328, mainly because we have increased the FY24 PATMI by about 3%, as we believe that the strength for Azure, it should continue as the enterprise, they shift their workloads to the cloud. And as Azure, it expands its user base. So that's all for Microsoft. I would now like to pass on to Glenn for UOB. Thank you.
Yes, thanks, Ambrish. So for UOB, they recently announced their first quarter results 1.5 weeks ago. So just a quick update on the results. The first quarter adjusted earnings of 1.577 billion was slightly above our estimates, and this was mainly due to higher other non-interest income and lower allowances, which were offset by lower than expected net interest income growth. And their first quarter adjusted PATMI is at 28% of our FY23 forecast. So jumping straight into the positives, first positive being that their fee income recovery is on track, and although they did post a 3% decline year-on-year, largely due to lower wealth and fund management fees, their first quarter's decline is significantly smaller than the previous quarter, the fourth quarter's year-on-year decline of 16%. And it also saw its first quarter-on-quarter increase in 4 quarters, rising 14% quarter-on-quarter. And this was largely due to a recovery in their wealth management fees as the investor sentiment started to improve. And likewise, their loan-related fees also rose, but their credit card fees sustained its momentum, and this is despite the seasonally softer quarter. The second positive is that their other non-interest income surged 457% year-on-year, and this was largely due to higher customer-related treasury income, which was driven by hedging demands. The management also noted that they had good performance from their trading and liquidity management activities, which boosted trading and investment income to an all-time high. The third positive is that their new NPAs fell 42% year-on-year as the asset quality stabilized during the quarter, and the NPL ratio remained stable year-on-year and quarter-on-quarter at 1.6%. For the negatives, the first negative is that their NIM declined for the first time in a quarter-on-quarter and this is since third quarter 2021. So their net interest income still continued to grow 43% year-on-year, and this is despite a loans growth decline of 1%. And their NIM also surged 56 basis points year-on-year to 2.14%. But as I mentioned earlier, it declined quarter-on-quarter for the first time in 6 quarters by 8 basis points. And this was mainly due to liquidity surplus placed into high-quality assets, as well as an increase in funding costs. And their loans growth decline was due to corporates paring down their borrowings, while trade and mortgage loans were stable. And as such, they have lowered their loans growth guidance from a mid-single digit to low to a mid-single digit. The second negative would be that their total allowances rose by 32% year-on-year, and this was mainly due to specific allowance increasing, as well as general allowance increasing. And this resulted in credit costs increasing by 6 basis points year-on-year to 25 basis points. Nonetheless, they have maintained their guidance for credit costs at 20 to 25 basis points for FY23. For expenses-wise, their expenses was also up 36% year-on-year, and this was mainly due to a continued focus on investments to enhance capabilities to drive strategic initiatives. So both their staff costs as well as their IT related expenses rose year on year. However, their cost to income ratio actually improved 3.9% to 40.9%, and this was on the back of strong income growth. So for their outlook, we do expect that their profit will continue to grow in 2023 on the back of stabilizing margins, stronger fees, and lower provisions. And we expect that their FY23 net interest income to expand 26% year on year. And we also expect their credit cost to come in below the guidance of 25 basis points. For their fee income, they expect that their fee income will recover from the low base in FY22, and for the growth to be led by credit card fees as well as their wealth and fund management fees. For loans growth, they do expect some slowdown in Singapore and North Asia, but ASEAN loans growth is expected to be higher, and they are focusing on high quality customers to continue loans growth. So a quick update on their commercial property exposure. They mentioned that they have some concerns in the regional market, especially from regional banks, which are one of their biggest financiers of real estate. However, they do not see any concerns in Singapore, which has their biggest exposure. And their biggest concern comes from the office sector, which only comprises around 2% of total exposure. And nonetheless, the majority of these loans are to gateway cities from network customers with a low LTV of 50 to 60%. So they don't see any problems despite the office market softening due to the pandemic, and people are more on a hybrid work from home, work from office sort of basis now. They do not see any problems due to the low LTV as well as the small 2% exposure. Even in the worst case scenario, they did mention that they are still comfortable with that the exposure can be managed. As such, we maintain a buy recommendation with an unchanged target price of $35.70, and our FY23 estimates remain unchanged. Now moving on to DBS. So DBS posted their first quarter results last week, and their earnings of 2.57 billion for the first quarter were above our estimates due to higher net interest income and fee income. And the first quarter PATMI is at 28% of our forecast. Their first quarter DPS is also raised 17% year on year to 42 cents. Jumping straight into the positives, the first positive is that their NIM and net interest income continue to increase. So their net interest income actually rose 50% year on year. This was due to a NIM surge of 66 basis points year on year to 2.12%. And this is despite loans growth remaining flat. So the increases in trade and non-trade corporate loans led by the Singapore real estate acquisition financing were offset by lower consumer loans as wealth management loans also declined. They have lowered their NIM guidance from 2.1 to 2.05 to 2.1%. I'll touch on this NIM guidance a bit more later on. For the second positive would be that their fee income rose 29% quarter on quarter, and their year-on-year decline moderated to 4%. So the previous decline, the year-on-year decline for the fourth quarter was 19%, and the third quarter was 13%. So it has moderated quite a bit to a single-digit decline. So it saw a recovery of 29% quarter on quarter, and this was from broad-based growth from an increase in wealth management fees, loan-related fees, as well as transaction fees. However, the credit card fees fell 7% quarter on quarter, and this was due to a seasonally higher spending in the fourth quarter. Excuse me. For the third positive is that for the second positive would be that their other non-interest income rose 35% year on year, and this was mainly due to an increase in treasury customer income and it being a seasonally higher quarter for them. For the negatives, the first negative was that their allowances actually rose 193% year on year, and this was mainly due to higher GP offset by a decline in SP. Nonetheless, their credit cost did improve by 9 basis points to 6 basis points. For the second negative is that their current account, savings account or CASA ratio fell 24% year on year to 52%. This was mainly due to the high interest rate environment as well as a continued move towards fixed deposits. Nonetheless, total customer deposits actually increased 2%. So for the outlook, we do believe that with the bank has sufficient provisions to ride out the current economic uncertainties, and while their CET1 ratio dipped 0.2% quarter on quarter to 14.4%, it is still at the upper end of their operating range of 12.5 to 13.5%. And as for fee income recovery, they mentioned that their wealth management and investment banking is recovering steadily. Excuse me. However, the pace of growth is still dependent on the market conditions. And while their card fee growth is sustained and supported by the ongoing recovery in travel, they said they have also seen a recovery in February and March of 2023, which has reversed the declines over the past year. But they did lower their guidance from double-digit to high single-digit, as the strong growth in January and February was offset by some market turmoil in March. So now to touch upon the loans growth and NIM guidance. For the loans growth, they did mention that they would see some impact from the recent cooling measures on their housing loan bookings, but their non-trade corporate loan pipeline remains healthy, and their wealth. And one more negative would be that their wealth management customers are also not increasing their leverage, choosing instead to withdraw from deposits. So this might affect their loans growth as well. As such, they have lowered their loans growth guidance from mid-single digit to 3 to 5%. And for NIM's guidance, they said that it has slightly peaked in the first quarter, and they expect a gradual decline for the rest of the year. And the asset pricing has actually been affected by the low HIBOR, and it has affected their NIM by 3 to 4 basis points. The repricing of deposits is also set to continue, which would further increase their cost of funding. Yeah, as such, they have lowered their NIM guidance from north of 2.1% to 2.05 to 2.1%. As such, we maintain a buy recommendation with an unchanged target price of $41.60, and we maintain FY23 earnings as we lower the net interest income estimates due to lower loans growth and NIMs, offset by lower operating expenses and provisions estimates. So now moving on to the next slide. Yeah, we're doing a Phillip on the ground on iFast for their first quarter results. Just to note that this is not rated. So the key highlights for iFast would be that their assets under administration fell 2.6%, and continue to fall, but it actually rose 4.2% quarter on quarter. So it showed some reversal. And the net new inflows of client assets also remain positive at 329 million in the first quarter. However, this is quite about less than half compared to a year ago. Their revenue was also down 6% year on year, and their net profit also down 19% to 4.7 million. Nonetheless, you look at their recurring net revenue, actually showed an uptick of 15.6% year on year. Their dividend remains unchanged at 1 cent for the first quarter. For the e-pension business targets, it remains largely unchanged and is expected to add around 17 million Sing dollars to profits in 2023, 44 million in 2024, and 88 million in 2025. So for the main update that they gave was for their iFast Global Bank, which is their UK bank they acquired. So they launched their digital personal banking platform recently on the 24th of April. And this is to incorporate into their vision of adopting a truly global business model and to incorporate digital banking capabilities into its fintech ecosystem. So this platform actually provides an online portal and mobile application for their customers from around the world to open a bank account, their bank account, to access deposit services. However, only in the initial stage, they will only be offering the basic bank account services like a bank account, fixed term, and notice deposit products across multiple currencies. But they do expect to release more moving forward after the initial stage has been passed. Okay, now for next slide. That's all for iFast. Yeah, so I'll just do do a quick banking update on the American banks versus Singapore banks. So this will be mainly on PacWest and what has happened to them recently. So if we look at the main figures here, we see that at least for the securities as a percentage of assets is pretty similar to Singapore banks. Their loan to deposit ratio as well, and their leverage ratio and ROE are all quite similar to Singapore. However, you look at the three things will be the assets and deposits growth. So the assets and deposits growth assets growth is more than double, and deposits growth is more than triple of the Singapore banks. And their CET1 ratio is also quite a bit lower compared to Singapore banks. So this might be what caused their downfall, that the deposits are not as sticky as compared to our local banks here. Okay, so that's all I have for the banking sector. I'll now hand it over to Darren. Thanks.
Yeah, thanks, Glenn. So CapitaLand and Ascott just released their first quarter business updates. Yeah, no financials were provided. And so for the positives, the first quarter RevPAR grew 90% year-on-year to $127. There's a chart right there that I put. So you can see the growth from pre-COVID, which is the fourth quarter 19 at 160, and how it crashed during the COVID era, and then how it slowly, gradually recovered until $127, which is now. So seasonally it's weaker, as you can see from the first quarter 22 as well, is it dipped from the fourth quarter 21. So Singapore, Australia, USA, and Japan are at or above pre-COVID-19 levels already for the RevPAR. And the standard stay segment also remains resilient for Ascott, and with a occupancy of 95%. And for the student accommodation, it is 98% occupied with 6% rental growth year on year. So this is still very resilient for them. One thing to look is at the chart on the left. It is the year-on-year growth for same-store sales, kind of year-on-year for the same country, same stores like same country RevPAR. So you can see Japan is 351% since its reopening back in October 22. So the RevPAR growth is really crazy, like 351% from first quarter 2022. So for the negatives for Ascott, they have a higher interest expense. Their cost of debt increased from 1.8% to 2.4% quarter on quarter, and their fixed rate loans decreased from 78% to 75%. And we expect this cost of debt to increase from 2.4% to slightly higher when they refinance their 14% of the debt due in 2023. So as for the outlook, the global airlines that are operating to and from China are only at 11% of their 2019 capacity, and we expect this to increase to perhaps around 25% this quarter. And Chinese accounted for approximately 9% of classes guest count. So right now is for this quarter, we think it's around 4% or to 4.5%, and in the previous FY financial year, it was at around 3%. So we expect this to slowly pick up over the course of the year. And the growth in ADRs, we expect it to moderate going forward as it has already surpassed pre-pandemic levels in some markets, and it's quite tough to see the ADRs keep increasing exponentially, especially since it's already back to pre-COVID levels. So going forward, we think the recovery will be from the occupancy, or rather the growth driver for RevPAR will be from the occupancy rather than ADRs. Right now, they are about 70 to 80% occupied for their portfolio. And classes revenue growth has outpaced its operation costs. So that is a good thing as well. And although electricity cost increase is still under 10% of their OPEX. So with that, we maintain our buy call with an unchanged target price of $1.26, and it class has a dividend yield, a forward dividend yield of 6%. Yeah, next slide, please. So FCT announced their first half results. So the results were broadly in line with our expectations. The gross revenue increased 6.5% due to higher occupancy, stronger turnover rents, and positive rental reversions, as well as contribution from atrium income. Because before COVID or during the COVID era, they couldn't have any atrium activity. So because of that, when atrium recovered, it kind of increased the top line for them. However, they were impacted by higher interest expense, especially since they drew down more loans to fund the acquisition of the 25% interest in Next, as well as the additional 10% interest in Waterway Point, as well as the higher interest rate cost. So for the positives, the retail portfolio occupancy improved 0.8 percentage points quarter on quarter to 99.2%. This was mainly due to the backfilling of the anchor cinema space at Century Square, taking its occupancy to 96% from 88%. So if you've not seen the news, Cathay has signed a lease with them, and they are going to open 6 cinema halls in Century Square. So occupancy at 9 of the malls came in at above 96.8%, with 5 malls having an occupancy of almost full on 99% or higher. Their first half rental reversions were up 1.9%, and to show that the leasing is still quite resilient for them, for their retails, for the retail side, 16.2% of their leases have already been renewed in the first half of 23, with only 11.4 yet to be renewed for the remaining half of the year, of the financial year. Another positive was that tenant sales and shopper traffic grew 9.2% and 35.3% year on year. And as for the outlook, we expect the improving tenant sales to lower occupancy costs further, and this will help to support FCT's ability to raise rents going forward. Currently, it's at 16% and it's at a 5-year low. During COVID, it hit about 20%. And some inorganic growth opportunities for them is to acquire the 24.5% effective stake in Next from the sponsor, as well as their sponsors, North Point City South Wing. So MPI margins are also holding up well at the 3% level, but we expect it to dip slightly going forward due to higher property expense such as utilities. And with that, we maintain our target price of we maintain accumulate with a higher target price of 2.35 as we raise our FY23 to FY25 DPU estimates on the back of higher portfolio occupancy. And FCT right now has a forward dividend yield of 5.5%. Yeah, next slide, please. So Mapletree Logistic, they announced their FY22/23 results last week. So this is Phillip on the ground on it, just some quick highlights on their results. Mapletree Log is a Asia-focused logistic REITs with 185 properties around with an AUM of around 12.8 billion. For the fourth quarter results, their revenue was down 2.2%. However, the DPU was flat at 2.268 cents because they paid out about 2.6 million from divestment gains, and the revenue was down mainly because of FX. A lot of these REITs were affected by foreign exchange, but at the bottom line, they were because they hedged a portion of it, so it kind of offset this impact of the FX. The portfolio occupancy is stable at 97%, and their rental reversions came in at 3.1%, mainly due to the Singapore properties, the ramp-up renewals, which were at around 5%. The capital management debt, the all-in debt cost rose only slightly 0.1% quarter-on-quarter, and 84% of their debt on fixed rates. The good thing about that is that about 77% of their forecasted foreign source income is hedged or derived in Sing dollars. So even though they are 77% hedged, they did indicate that they are not they will still face some headwinds from FX, even though they are relatively hedged. And this is just some cap rate numbers. As you can see, Singapore expanded 50 to 100 basis points, and so on and so forth. Yeah, and next they have the portfolio rejuvenation. They have a proposed acquisition of 8 logistic assets in Japan, Australia, and South Korea, and this is at 4% discount valuations. They did an equity fundraising last quarter, and they raised 200 million through a private placement, and this was 3.9 times oversubscribed, and with it was priced at the upper end of the range as well. So we can see that there's still quite a lot of demand for MLT. They also have a potential acquisition of another 2 logistic assets in China and a potential divestment of a property in Hong Kong. So for the outlook, they indicated that their cost of debt will land at around 3% for the coming it's FY23 to FY24, not 34. They indicated, like I mentioned before, that they'll still face headwinds from FX, even though they are relatively hedged. And they also see weak rental reversion from China, especially since the China's e-commerce players, they expanded so much space. They expanded so much during the COVID era, and right now they are shrinking their space by about 10 to 20%. But the good thing is that they have informed them in advance that they will be shrinking. So MLT has ample time to look for other tenants to lease a space. And they are also focused on asset enhancements and capital recycling. For their FY22/23, their dividend yield was at 5.1%. Yeah, so that's all for me. I will hand over the time to Zane for technical analysis. Thanks.
Thanks, Darren. Good morning, everyone. Now I'll move on to the technicals. Next slide. So for S&P 500, last week, we actually broke down of the uptrend channel. So for currently, we could be trading more of a range pattern, consolidating the recent uptrend movement. So for now, the resistance is likely to be at 4,170, which is the recent high that the market couldn't break through. Stretching to about 4,230, which would be a retest of the uptrend channel. As for the current support, is likely to be at 4,050, which is the recent lows, which we retested twice recently. So about 4,100 area, which is also the psychological level. Next slide. For individual counters, we have Lion OCBC Hang Seng Tech ETF, HST. So for this, is the technical buy at 63.5 cents. Take profits can be set at 67 cents and 70 cents. The stop loss at 61 cents. The stop loss closed at 63.8 cents on Friday. So for HST, the overall pattern is could be a range bound movement from about 63 cents to about 70 cents when we look at the chart. So price is currently lying retesting at 63 cents level. So that could be a good buy for now. Since that we actually since there's actually a bullish divergence observed on the RSI as well as the MACD, where we saw price retest the support level and also a higher low being posted on these indicators, which indicates some bullish momentum being present. For now, the price will retest the first level of resistance at 67 cents, which was a previous support level that broke down in April this year, followed by 70 cents, which was a key significant resistance, which we tested twice in March and April and couldn't break through. So for now, HSC could follow this range movement. So that's all from me today. I will now pass on my time to Paul to talk about first quarter update for Venture Corp.
Yeah, thanks, Zane. So Venture released its results on, sorry, go back to the first prior slide. So Venture released its results on Friday. It was a first quarter update. They don't give a full set of results, but as the title suggests, I think the key message for Venture is that the weakness is going to persist into the coming quarters. Next slide. So for us, the results was below expectations. It's roughly around 20% of our full year earnings. You can see from the chart on the left, so the revenue declined 8% and profit was down 12%. And profit is quarterly wise is one of the lowest, I don't know, in 3 years, almost 3 years. The positive is, as usual, Net Venture always has very strong net cash position, and that improved in this quarter by 100 million year on year. There were two negatives for us. The inventory continues to be elevated. So the inventory is still hovering around 1 billion. And that is a worry because, you're entering into a slowdown in demand. By inventory days, they're usually around 100 days. Now is 30% higher or 40% higher at 138 days. And the other problem for Venture, this is a more longer term view, is that the revenue is shrinking again, of course. But since 2017, when they hit the record 4 billion, they have not been able to cross that 4 billion record. And considering the last 2-3 years, most of the electronic companies, most of them, if not all, break new record highs in terms of revenue and profit. So in terms of our outlook and recommendation, they explicitly guided that there's going to be demand weakness expected in the near term. So this actually comes from them in their outlook statement. And one of the reasons is just that customers are turning more cautious with their orders. So it's more of a macro reason. So as a result, we cut our earnings by 13% because we lower our revenue by 12%. No, we were expecting revenue to actually rise maybe by 5%. But of course, we're totally out. It's down 8%. So we think we're lowering our full year revenue to maybe a -5%. As a result of that, we're also cutting our target price from 1970 to 1710. Next slide. Okay, so for Siong, actually, this is a bit, I mean, a couple of days ago they released, but the lag effect, what we were trying to say is that they got hit badly by higher electricity and wages. Next slide. So the results was within our expectations, 25%. You can see from here, revenue was basically flat, the table on the left. And the positives was that new stores added 3.6 percentage points of growth. So one thing good about Siong is they do give a bit of details of where the revenue source is. So if you look at the table on the left, sorry, it's a bit small. So you can see that revenue was flat or down 0.4, but most of the growth came from new stores. So 3.6 percentage points growth from new stores. But the problem they had was same-store sales. That means same-store sales means, you know, the old stores. How is the old stores growing? So that's down 3.6%. The negative is that although revenue was flat, you can see that on the table on the left, earnings was down 5%. So they got hit quite badly because of all things. It's pretty unusual, but it's because of higher electricity. So end of last year, they negotiated, you know, because most of electricity contracts on a, I don't know, 2 or 3 year period. So they had to renegotiate now, and then they had to take on additional 2.4 million of electricity. This was explicitly mentioned by them. And this is huge. I mean, considering they made like 33 million. So this is almost 8% of impact to their earnings. So in terms of outlook, there's no change in our forecast or recommendation since they met our expectations. Not target price, sorry, the recommendation, it's a typo here. The recommendation was lowered due to the share price performance, not the target price. Our target price is unchanged. Sorry for the typo here. So for us, we think growth can resume in the second half, revenue growth, mainly because if you look at the results again, first quarter, they had a negative 3.6% same-store sales, but it's actually improving from the 7% decline. So what has happened, I think, as we all know, with the reopening, what has happened is that more households are dining out, and as a result, they're obviously not buying in as much groceries as in the past. But for Siong, the good thing is they are taking market share. It's not in the slides, but the industry in the first quarter 23 was down about 3.5%. But Siong's revenue is flat, so by default they actually took market share. And that's one of the growth stories. But for Siong, most of the growth is going to be new stores, and we expect 2 to 3 new stores this year. They currently have like 68 stores because they opened one this year. First quarter, sorry, yeah. Thanks. Next slide. So we go through our usual weekly update. Next slide. So in Singapore, most of the data was actually quite weak. So PMI, which is basically a manufacturing survey, and it continues to be sluggish, 49.7, and then this is the third month of decline in weakness. But of course, the numbers can be a bit volatile, but in general, there is manufacturing activity is still weak as we up until April. We also had retail sales in Singapore. It is up 4.6%. It is slowing down the retail sales because you get after this pre-opening, reopening impact. But 4.6 is still a good number considering pre-pandemic, our retail sales in Singapore was probably around 1%. This is just to show what are people shopping, I guess. So restaurants are doing well, supermarket is down, apparel, watches is flat. In terms of construction, contracts also was still weak, but it's picking up from January to February. So this is contracts awarded by the government, public sector and private sector. But again, this is also a bit of a sluggish number, but we think it will pick up because the BCA is really kind of guided for at least the 29 billion, so it should still be strong. Maybe just the first quarter has still been weak. We got the big headlines which propped up the US market with the strong payrolls. The payrolls numbers are actually very strong because firstly it's higher since January, and it was very broad-based. So the last month, which is March, we saw weakness in manufacturing, but this time around, it was quite broad-based across many services was up, of course, then manufacturing also was up. Unemployment rate in the US is more than a 50-year low. The one thing as reflected by all the weakness in electronics has been US imports is also down 30%, and the global trade is falling down quite sharply. US is not importing much. Obviously, like 30% down. And this is their 8 month of contraction. Next slide. So in terms of our technical views, okay, firstly, we think all these regional banks, First Republic, we think the malaise has not ended. And this will definitely hurt the US economy because what we see based on the latest data points in the US, the deposit outflows from their banks is reaching or accelerating to now almost 137 billion a week over the last 2 weeks. So so what we think is that banks need to raise cash. I mean, when your deposits are flowing, you're going to raise cash. And how do you raise cash? I mean, without tapping on the market. And even if you try to tell market, the cost of funds is going to rise. So we think they will, of course, stop is a bit aggressive, but they'll probably, if not stop, they'll definitely slow down lending and they will slow down refinancing of loans. So this will obviously be a dampening effect on the US economy. On the Fed funds rate, they raised 25 basis points. But from our point of view, I think they did hint of a pause. Firstly, Powell explicitly mentioned they retracted this so-called additional firming language. I mean, it's a bit sometimes a bit ridiculous. Every word they say, every sentence also we monitor. But anyway, the last meeting he said there was additional firming, so this time he said didn't. So we thought it would be like a pause. Second reason is that he also said that the rates are meeting the Fed forecast. So every 6 months, the Fed will come up with a forecast, the summary of economic projections. And that is they already forecasted the end of this year about 5.1 and already reaching there. So for these two reasons, I think they kind of, I mean, for us at least, they kind of hint there's going to be a pause in interest rate hike. And the third reason, although this is not in the meeting, but we think if they still continue to raise rates when the banks are hurting so much, it's going to hurt the bank balance sheets. So why it hurts the bank balance sheets is because of course they have US treasuries and these are fixed interest rates. So when interest rates go up, of course the bond price will come down and they're going to get hurt. Of course, the less well-known thing is that US banks like First Republic, around 70% of their loans are fixed interest rates. So, so they are probably lending someone at maybe 2%, and 2% interest rate for some are 30 years, some are 10 years, and interest rates are now up to 5%. So obviously they're losing money. So if the Fed continues to raise rates, it's going to hurt them. This is the reverse for Singapore. For Singapore, 70% of the loans are variable. So when interest rates go up, we're going to charge you more. But for US regional banks, when interest rate go up, they actually lose because the customers only paying them, I don't know, 2%. Whereas for Singapore banks, they will charge you immediately. I think you get the reminder in your letterbox. Okay, so for our view, we think tactical view is probably just to look for long duration assets. So what we mean is that if interest rates have paused or could come down maybe next year, investors will probably want to look for something that can give dividend yields for long term, because something that can lock in dividends or yield that's what we mean by long duration assets. That means you can have high dividend yields or high interest rates for a long time. I mean, this is just maybe don't want to confuse them with the word duration. It just means very long dated assets, not short-term money, just long-term money. The other thing is also one way to get uncorrelated returns. So if you assume global growth is coming down and US is still raising rates, one way to get uncorrelated return or not linked to the US is China, of course. Because China is the other way around. China is rebounding and then interest rates are coming down. So it's like the opposite of what is happening in US and globally. In terms of some of the key events, the main one will be the OCBC results on Wednesday, and the big one in the US will be the inflation data coming out. Another one that could take a bit of noise will be on Tuesday when Biden will have some meetings to talk about the US debt limit. Some of the webinars we're having is OUE City, if you want to get an update on what's happening in Singapore retail and office. We also have a US company doing a webinar with us on Thursday. So OUCT is Wednesday. Next slide. So just to give you a sense of the outflows. So the outflows is cumulative. So initially in the 12th of April, there was already 200 billion exiting the commercial banks in the US. But after that, when all this news of First Republic came out and so forth, you can see the exodus of capital. It really surged. In 2 weeks, it was down about more than 200 billion. We don't have the latest data because up to 26 April. A lot of it went to money market funds. But if this continues to flow, you will just put more stress on the regional banks. Next slide. Okay. So let's 3 slides. So we have our usual model portfolio update every beginning of the month, because 1st of May was a holiday. So this is our top 10 stocks. We were up about 4.5%. Again, this is just for illustration. And bulk of the gains came from Propnex and CapitaLand, Ascott. I'm not sure why, but after the bonus issue, the stock price exceeded our target price, which is 120 adjusted, because there was a 1-for-1 bonus issue for Propnex. And the worst hit was Comfort Delgro, in part also because of the cooling measures that hurt sentiment. Next slide. So this is just a snapshot of all the performance in April. So you can see in April, the sectors that did the best was, in general, the hospitality REITs did the best. I think the results, strong results also helped a lot. Shipping, telco, the worst was commodity stocks. I think like Wilmar and so forth, which was down 7%. The table on the right is just to show you some of the gainers and losers. The bottom is all the index, the index ETF gainers and all, and the large cap gainers and so forth, just for your info. So SETS, Wilmar, CDL, these are the worst performers. Next slide. And this is just an update of all the asset classes. We usually just update everyone. So what did well was still did well in terms of 1% gain was considered doing well in April. So for Singapore was basically did nothing. It went flat 0.1. The blue bar is year to date. So year to date, Nasdaq has done well. But the funny thing is that even though global growth is slowing down because commodities are down, but Nasdaq is up. Yeah, because I guess the FANG stocks are the ones that's doing well. The second point is gold is doing well, of course, and it's probably close to record highs. Thanks. I think we can. I think that's my last slide. Yeah, thanks. I think we can move on to Q&A. Thanks, everyone.
Okay, thanks, Paul. Let me take some of the Q&A first. Okay. The first one is
sorry, Glenn. Just a quick. I know I see some of the comments here, symbols and text. Yeah. So thanks for the feedback. I think we will try. Thanks for all the update on the presentation slide. So we will try to increase the font size and do some of the changes as recommended. But thanks for the feedback. So we welcome any feedback you have on the slides. Yeah. Oh, sorry, Glenn. Yeah.
Yeah, no worries, Paul. Okay, so the first one is, hi Glenn, will DBS lower CET cap ratio of 14.1% affect DBS going forward in competition with the two other local banks? Okay, I don't think it would really affect them in competition if you're talking about that strictly. Because I mean, if you look at DBS, what they have going for them compared to the other two banks at least would be their very large deposits size, and as well as their high focus on the net interest income, portion of their business. And yeah, I don't think this will affect them as much going forward, because the banks are not really competing with each other on the CET ratio. And also, I mean, it's still above their operating range. So they really did mention multiple times that they're looking to reach the optimal, which is 12.5 to 13.5%. So this 14.1% actually is still above. And I think this answers to the second question below as well. Hold on, let me find. Okay, yes. Please discuss the impact of the DBS outages on DBS and banks in general, please. Yeah, so DBS, I mean, this is I think the second time in a short while, in like a year, less than a year, that they had this outage. So what happened? What they had to do was now they have a 1.8 times multiplier on their capital requirement. So now instead of, give me a double check. Yep. So now it's 1.6 billion. All right, compared to 1.8 times to 1.6 billion, compared to the previous outage, which the MES increased it to 1.5 times. That was 930 million. So this, what might this cause for DBS, at least specifically? It might put a cap on their things. Maybe they want to acquire something, some other bank or some acquisitions in general. So this might put a sort of a pause to that before it's removed this additional capital requirement. And also they might not be as aggressive in increasing their dividends as well. But they already have increased it once, and it's now 16% higher, and I don't think they're going to lower it. So we might see this current dividend at this level for some time before at least this whole additional capital requirement issue is resolved, and they can do their own review on what happened. Yeah. So what will happen to the other banks? I think they might be more they might be, maybe MAS might be more strict in sort of ensuring that this doesn't happen again. So with DBS, they still haven't come out to say what happened, but at least with OCBC and UOB, we haven't seen this happen in quite a long while. So maybe it's something with DBS's systems or what, we don't really know until they come out with the review. Yeah, so hopefully they get it fixed. Hold on, let me find. I think I have one more question regarding CASA ratio. Where is it? Oh yeah, what is CASA ratio and its formula? So CASA stands for current account savings accounts. So its formula is basically just current account savings accounts, the amount over or divided by the total deposits amount. So it's just a this sort of indicates how much of their total deposits are current account savings accounts. So this current account savings accounts actually is the lowest cost of funds for the banks. These are what we have in our current account savings account. So like our multiplier account, the one account. Yeah. So this actually has the lowest cost of funding for the bank because they give the lowest interest rates as compared to fixed deposits. Fixed deposits, you don't need to meet any requirements to get that rate. Whereas for these CASA accounts, you need, as everyone would be familiar, you need to meet the minimum spend, you need to have salary credit to get whatever percentage they have, a promotional percentage. Yeah, so this is actually the lowest cost of funds for the bank. So the higher it is, the CASA ratio is technically better for the banks. The lower it is, it's not as good for the banks. So recently we have seen, at least across the board for all banks, that the CASA ratio has been declining. And this is of course mainly due to the higher interest rates. So while they have increased the interest rates for both current account savings accounts with all the the multiplier and the one account and the 360 account, however, they have also increased their fixed deposits account interest rates, and this is guaranteed amount. So there's a shift towards this current accounts towards the fixed deposit. So that's why we are seeing this decline across the board. But in overall, we look at the deposits, it has actually risen year on year as well as quarter on quarter for the banks. Okay, just let me briefly run through and see if there's any other questions. Okay, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Yeah, thanks, Glenn. Yeah, so a couple of questions for me. Hi, Darren, could you share with us on what may be causing the recent drop in share price of Elite Commercial REIT? So for Elite Commercial REIT, they came out with their first quarter business updates last week. The results weren't too great. So for their base portfolio, their rental, a lot of their rental escalation are pegged to the CPI. So because of that, a lot of the rentals, the good thing was that they came in at about 21% and a 15% rental uplift, because it's for their leases is accumulative. So it's not every year you see a step up in the rentals. So for theirs it's accumulative, and then one shot, I can't remember, is it 3 to 5 years, but yeah, but within that time frame is a one shot increase. So which was just this FY, so which was why 21%, they saw 21% and 15% uplift in their escalation for their rents. But then they are hit badly by the interest cost, because 2 quarters ago their interest was only about 2%, but then when they refinanced their loan, their interest shot up to about 4.9%. So their interest cost actually almost doubled. And right now they are about 68%. They're only about 68% of their debt is on fixed rate. So we also expect that the Bank of England to raise another 25 basis points later this week. So they will land the rates at about 4.5%, the base rates. So this will also affect their borrowing costs going forward. So because of these 2 headwinds, as well as some vacancies in the portfolio, like they indicated that that they're seeing of 12 vacant assets or vacating assets in their portfolio, and they're trying to negotiate for more to release these assets. So because of these headwinds, such as these 3 pointers, like the vacancy and increase in borrowing costs, as well as probably the Bank of England going to raise another 25 basis points. So these are some near-term headwinds which is why the share price kind of dropped quite a little bit today. Yeah, that's all the reasons I can think of. Yeah, so basically that the results weren't too great. Yeah, the DP was down over 25% because of the sharp increase, the spike in interest expense. Yeah, so that's for Elite Commercial. Then I have a question on Manulife. So any updates on Manulife? And then a similar question is also on updates on Prime. Yeah, so I'll answer these two questions together. Where Prime US REIT heading considering the current US situation? Yeah, so the same thing. Not much difference in the sentiment. Like a lot of the US reports coming out saying the US assets are having some issues, office assets especially. But the good thing is that we will have more clarity in the later part of this week because they'll be releasing their first quarter results, both Manulife and Prime on Thursday. So for Manulife specifically, we do not know any updates on their restructuring or their plans to their strategic review. So that one they'll give some updates in the first quarter results, which is on Thursday. So yeah, if you could come back next week, then I can update you on that. But for now, I do not have any further updates from what I've already updated previously. Like they divested one asset to their sponsor at book value, and the Mirai acquisition of some units. Yeah, so those are the latest updates. And so all this is also affecting Prime US REIT because in Manulife facing some issues and headwinds, it's hard to see a peer such as a Capital Pacific Oak as well and Prime trading the other way from Manulife, as all this is sentiment based and they are so closely related as they are all US office assets. Yeah, so there's also another headwind for Prime, but yeah, other than that, we have to wait for their first quarter updates on Thursday. Then I can give you more updates on Prime and Manulife, but no difference from last week's sentiment. And then there's another question on yeah, good morning team. Just a general question here. SG banks give out a lot of floating rate loans. How does this resonate with S-REITs which have mostly Singapore bank loans? Many S-REITs claim they're fixed rate loans. Thank you. Yeah, so a lot of S-REITs, most S-REITs, they borrow from Singapore banks, but then a lot of them, when they claim that they're fixed rates loans, actually a lot of it may not be purely fixed rates from the banks. A lot of it is actually hedged separately. So maybe they borrow floating rate loan from the Singapore banks, and then they enter into an interest rate swap or some other form of hedge to hedge the interest rate into fixed rate loans. Yeah, so yeah, I think that answers the question. Yeah, I think that's all for me. I'll hand over the rest of my team. Thanks.
Okay, I'll take the next one. Okay, there's a question on KIT. Hi, can advise if should take up KIT preferential offer? Thanks. Okay, just to recap, the preferential offer is at 0.467 cents. The offer price was estimated about 0.49 to 0.5. So I think the price is right around this level. One main consideration is it will be fully subscribed because the book runners are committed to take up all the shares that have not been taken up, and the dilution is fairly small, with just about 11 to 12% of the total enlarged share cap. So we think it will be taken up fairly well. Also because at earlier they had a placement before this, and that was very well subscribed. I think some of the funds are taking up also because they want to raise their ESG portion of their portfolio, because KIT is adding renewable assets to its portfolio, which will raise its ESG component. But again, want to reiterate the caution, note of caution here is that distributable income might drop in this year, which they also warn, because Keppel Marymount cogen plant will have to start repaying their debt, which is about 88 million each year from this year onwards. So that which wipes out all the contribution from Keppel Marymount. Keppel Marymount contributed about 43 million Sing dollar distributable income last year. So 88, half of that 44. So which means they will not going to contribute any further from here if they could not refinance the loan. So that is one point to note. Otherwise, if they are able to maintain distribution, then the yield is still attractive at about 7.5 times. So we think we should take it up. There's it's the price, the offer price is fairly attractive. Okay, and there's another question on the Semcorp and C-Stream. Let me pick that up. Okay. Semcorp and C-Stream a buy, advise short hold or long hold. Okay. And there's some yeah, on the 11th of May, MSCI was going to announce the component review of the some of the key indices. So there's some moment yeah, that Semcorp industry and C-Stream might be included. It is just a rumor. Okay, don't take me for don't take my words for it, because if I look at it, C-Stream is still will still be in a loss making for this year. Although they announced two contract for two platforms that will add 500 million Sing dollar to his contract, to his order books. We think this year is still a year where they incur costs to do the restructuring and integration. So we're not as optimistic. And also C-Stream Keppel has a block of 5% and is likely to be in the market. So the price might see some pressure from there if this block is being shown more aggressively. Okay. For Semicon industry, we are much more positive because most of the earnings are locked in, and the energy sales are on long-term contracts has been secured. So they can see profit visibility much clearer. Comparing the two, we think Semcorp Industries has a better upside compared to C-Stream. I hope I've answered the question. Thank you. I'll pass it on to the rest of my team. Thank you.
Sean, you want to?
Yep. Okay. Maybe I'll take on the question. Sorry. Maybe I'll take on a question on hi Paul, for long-term assets, SSV June auction at 2.81% yield, is it still good? Or in terms of SSV, it really depends on the type of investors that you are, because for the benefits of SSV is that there's this flexibility in the redemption of their principal on the every first day of any given month. So as well as the low barrier of entry, because for SSB barrier of entry, it's only $500. But do note that every individual has a maximum limit of 200,000. So, but for this latest issuance, we can see that it has already taken the hike cost into consideration. So with its yield throughout the 10 years being stagnant at 2.81%, so there isn't really any benefits for holding on to these papers for the longer term. So personally, I mean, if you have a shorter time horizon, I believe that our 6 months T-bills are still offering quite attractive yield at the latest cutoff was at 3.83%. And for 1 year T-bills, it's at 3.58%. But if you're looking at longer tenor notes, then perhaps you can look at maybe statutory boards notes such as HDBs as well as PUBs. But these notes, although they are offering slightly higher yields, maybe around the 3% range, but the minimum requirement size for this notes will be 250,000. So that will be slightly higher. But if you are looking at flexibility wise, I mean, SSB, it's still okay. But do note that for future issuance, do be prepared for lower yield issuance, lower than 2.81%. But if you're looking into flexibility, like I said, then SSB is still the way to go. Yep. You can adopt a ladder strategy to reach your 200K limit. Yep, I hope that answers the question.
Thanks, Sean. So basically, in conclusion, avoid the SSB, I guess. I'll just move on to some questions. Hi, please comment on the outlook of SGX listed E&E or electronics, namely AEM, UMS, Venture, Franken, and any good buys. For me, I think the downturn could last longer than expected. I think the weakness, the issue I have is that the expectation is second half can recover, but that is because everyone is assuming there's a inventory being rebuilt. But the thing is, how much is the rebuilding? Nobody knows. And I'd be suspicious whether the inventory rebuilding will be that strong, because if US really decelerates as we think it will sharply in the second half, then I think any inventory replenishment can only disappoint. It doesn't mean they replenish back to the old levels. It might just replenish at a very minimal level. So I'm a bit more hesitant on the electronics company. The timing is just more of timing, maybe at the end of this year. And like we mentioned before, the electronics will rebound. If there is a rebound, I think Singapore or Southeast Asian electronics will do much better, I think. Because there's a very clear shift from China to Southeast Asia. I don't have the chart, but if you look at the trade deficit numbers, the recent trade deficit numbers, Southeast Asia is skyrocketing, but China is collapsing pretty fast. So there's that clear shift out. For me, one way to time it is maybe like someone like Venture that is paying 75 cents. So it's very hard to pinpoint the very bottom. But if you hit a level where you think they can give maybe a 5% yield or 6% yield, then I think it's pretty attractive to just sit there and wait, because you know that this is just a cyclical downturn. It's not a structural issue for them. Sorry, that's the best. For me, I'll rather wait until year end, because I don't think the rebound will come in the second half. I'm not sure I actually answer, because basically there's no good buys. I mean, to answer the question right now. Okay, your comments on Aztec Global in the next 6 months. Okay, for me, actually Aztec's results wasn't as bad. They were hit a lot by their usual problem of forex. I didn't attend the meeting. Somehow I always get kicked out for the meeting. But anyway, I don't think if there's a rebound, I don't think Aztec will take the lead. I mean, they are a value stock now. I think the yield now should be almost 6%. Their valuations are very cheap, but if you buy electronics not for value, maybe apart from Venture, if you want to buy electronics, you're buying for the momentum. I don't think the momentum is will be led by Aztec Global. So for me, if I'm going to buy electronics in Singapore, at least I'll just eyeball UMS and AEM and just wait at a later period. Yeah, because any rebound will come from these are the leaders in the sector. Aztec is, I don't know, obviously not a leader. It's a value stock, but I know value stock for electronics don't really go anywhere. Yeah. Okay. Your views on Alibaba. Sorry, we don't really cover China stocks, so apologize. We are mini Singapore analysts, so we can give you an answer, but again, as usual, it's all wrong. But so that's why we don't give any answers on China stocks. Paul, can you give some suggestions on long duration assets? I think for me, it's going to be REITs. I know it is weak and everything. So don't like we mentioned before, don't expect REITs to grow. It's almost I wouldn't say impossible, apart from the hospitality REITs that can outrun the higher interest rates. I think the rest is going to be very challenging for them to grow DPU. But in this macro environment, you know, where interest rates we think peak or can come down, I think REITs, because REITs can still give like a 5-6% yield, or 6%, actually should be around 6% yield, and we think they can maintain it. I think they can maintain the DPU, but grow is I don't think it's gonna happen. I think like Darren mentioned. So if you either buy the large cap ones or you just buy a REIT ETF. I mean that's my own view. That's my view on what we mean by long duration assets. That you're basically trying to lock in a yield, interest rate. But of course, of course bonds also can. But I think the problem with bonds is that they really kind of corrected quite a lot, like what was mentioned in the SSB. So just my own thoughts. Yeah. Okay, do any of you have any view on iron, lithium, copper price going forward? Yeah, on SGX, sorry, ASX mining stocks we don't cover. Yeah, sorry for that. Yeah, but based on what is happening in China, I think it could I think the property market, fixed asset investments in China could surprise, because based on, like we showed last week or 2 weeks ago, the amount of liquidity the Chinese government is priming is at record levels. Yeah. So this will need help up positive. Okay, I'll answer this last one. Then I think probably for the rest, I think a lot of questions for KIT. What's your take on Samudra shipping post dividend, and what's your outlook for freight rate next year? Is it going to be tough? Okay, so Samudra, for those who don't know, is a container shipping company. They own container vessels, and mainly in the intra-Asia region. They don't have the big I don't know, 10,000 TEUs and so forth. But it's going to be tough. I think freight rates are down 80% this year. So and this is like another glove sector. You know, they had 2 good years, and then it's going to be weak for, I don't know, another few years. Number one, because there's a lot of ships order. I think on order, the last time I checked, don't hold me to the numbers, but on order is almost equivalent to equivalent to all the supply out there. So the supply could actually double. If I'm not mistaken, when I looked at the last time, because when the problem, everybody generated a lot of profit and everybody started ordering a lot of vessels. That's number one. And number two, you know, the demand is weak. Like a few weeks ago, we showed the US imports, container imports, is down 30%. So this is just like global financial crisis kind of weakness. So we think it's going to be sluggish. So it will recover a bit, half and half, like we said. But like I said, nobody's going to replenish inventory when retail sales is going to be big. So we think it's going to be a tough for Samudra for the next, I don't know, 12, 18 months. And this year is very bad. This year, the container rates just collapsed 80%. Yeah. Okay, hand it over to the rest. I think that mainly for Peggy. Yeah, thanks.
Yeah, okay, thanks, Paul. Okay, okay, let me read out the question first. Hi, Peggy. On KIT, assuming the distribution were to drop as stated, what will be the yield then? Thanks. Okay, the company has, all the while I've been talking about is distributable income, but they don't distribute all the distributable income. So last year they distribute only about 85% of that. So they're maintaining their distribution at about 3.8 cents. They hope to maintain that distribution 3.8 cents per share. So you take that 3.8 cents divided by current share price, you get about 7% yield. So this KIT does not function like a REIT. They have a discretion on how much they want to pay out, not exactly 90% of their free cash flow. Right. Another question is, okay, I'm not sure whether when I say distribution will fall, it's because the absence of a KMC's contribution, and that is highlighted by the management themselves. So that when we usually don't get this kind of warning unless it's quite it looks quite real. So we have no doubt. No, can't say that. Okay, let me read the other questions, then I answer. Wouldn't KIT be able to refinance the KMC loan, judging they have a strong sponsor? The thing about this KMC loan is it's structured such a way that about the loan is in the KMC has two parts to the loan. About 260 million is due to the minority shareholders. Is a loan taken from minority shareholders at 17.5% interest rate, and this has never been repaid, and not much have. I mean, it's more like a. It's only due at the end of the period, so the end is beginning right now. Okay, with Keppel and Temasek as a sponsor, there is of course a very high chance of this loan being refinanced. The doubt I have is that at this current interest rate environment, what kind of refinancing structure would they get into, given that in the earlier structure they had was very favorable to them, where you don't have repayment of principals. But from here onwards, if the structure will be different, then your cash flow pattern will change for KIT. That was what I'm trying to highlight. I hope I answer that question. So which means that while the KIT tried to maintain a 3.8 cents payout, this KMC loans new structure might change that projection. Okay, I have another question from also on this. Wouldn't KIT be able to refinance the KMC loan, judging they have a strong sponsor and there are other acceptable metrics? When we spoke to them, they also sounded confident that they can do it, but it's only the structure that make us concerned whether they will change their distribution cash flow from here onwards. Okay. And another question on outlook for sets considering tourism and hospitality, anticipating growth from Chinese tourists. Okay. The thing is, SIA has already reached about 80% of its pre-pandemic volume. So, the sets volume has actually grown much earlier than before that. So in this recovery of tourism and hospitality, sets has actually get itself prepared for it. So it's most of the benefits already probably happened in the first quarter of this year, which is over. The thing about sets that is weighing down on the price, we feel, is that on the consolidation of WFS, because the last numbers that we have on WFS was in the circular acquisition circular, which was dated as at September last year. So sets year end is in March. So we're waiting for the March results to see after the consolidation how much debt they will inherit from this exercise, how much more gearing they have taken up to do the acquisition, and also based on the EBITDA numbers that WFS disclosed at the end of in the month of December, it looks like WFS was EBITDA negative. So there's a concerns over here as to after the consolidation, how does that numbers look like? I think this is the thing that's weighing on the share price right now, because after they acquired WFS, this tourism, this Chinese airport business will drop to around about 50 to 60% of their total revenue from in the past about 80-90%. So the cargo business in US and Europe becomes a bigger component of their income, and will impact the earnings much more in a bigger way. So therefore, that's a concern for sets going forward. So I think I also answered the question on immediate outlook of sets. Yeah, there's the consolidation of WFS. I think that's all for me. Thank you very much. Pass it on to the rest. Thank you.
Okay, thanks. Let me just answer one. Let me just answer one question. Then we can move on to the technicals. Hi, Paul, can you elaborate on the credit market surprise from liquidity pump from Chinese government again, please? Is TLT a long duration asset? So okay, let me just share my screen just for once. Okay, so when I say liquidity, what I mean is actually this part here. So I think we showed this a week ago. Basically, what we're trying to say is that the Chinese government, I mean, in the end, it's still Chinese government. You see this huge surge in liquidity, and usually, of course, where this money ends up could be refinancing, and it's not really a positive. I mean, if you're going to grow by having such a huge amount of debt, but anyway, so what we think is that if this liquidity surges, there is a chance that the liquidity could go into fixed asset investments and residential market, and this is where you get the uplift in commodities that could surprise. Again, this is one thesis. I mean, you just have to monitor whether it's actually happening. Yeah. Okay, I just wanted to share that. I think we can move on to you, Zain. Let me stop share.
Okay, thanks. Let me just share my screen.
Sorry, just a quick one. The answer is TLT a long duration asset? Yes. So TLT is invested in US government bonds more than 20 years. Thanks.
Okay, thanks, Paul. Apologies if my audio sounds a bit weird today because I'm using Bluetooth connection. My earpiece died. Okay, so without further ado, let me begin with the TA. I'll go through the Singapore and Hong Kong first, and followed by US if time permits. Okay, so first one is Delphi. So for Delphi, we actually recently the price broke out of the $1.12 to about $1.14 resistance over here. We tested about $1.32. I think for now the price could be doing a little bit of a pullback consolidation. Since that when we look at the past data, 132 was a significant resistance level back in 2019 over here in January, as well as in January of 2018. So I think price for now will probably do a pullback to consolidate some of the gains. But overall we are still in quite a nice bullish momentum over here. Then next one will be Genting. Okay, Genting following the quite a long bullish run. I think for now price is starting to trade in a downtrend channel over here. So this was after we hit the key resistance at $1.15. Price actually started to turn downwards. For now, I think the some support is probably around at $1.06 to about $1.08 over here, which is the channel support, as well as a previous horizontal resistance we broke out of northern support. Resistance will probably be from about 110 onwards to about 113 for now. So I still think that for now price is probably just going to trade slowly in this downtrend channel for now. Yep. Then next one will be OCBC. So for OCBC, I think there's some weakness recently in the share price. This was because we actually broke down this rising wedge, which is a bearish pattern, and we can see that price is just been starting to turn down. And another thing is that today we also fell below the 1250 level. I think it's because of the dividend. So this chart is a bit inaccurate. So for now, I think price might actually go a little bit lower to probably maybe reach about 1220 level, which was a previous horizontal support level. And the lower levels could be around near $12 for now for OCBC. Okay, let me move on. The next one will be city development. Okay, so for city development, I think despite the recent pressures on property counters, I think for now it should be able to hold up. One reason is that actually we tested this main uptrend channel support over here. That's around close to a 680 mark. And then at this 680 level, we can see there's also 61.8% of Fibonacci support over here. So this was when we take the lows at 580, which is COVID lows, and the highs is at 838. So this marks another support level. So for now, I think price is rebounding onwards from here, but there should be some resistance coming in soon at this level, which is around 710, which is this support level that we broke down following the gap down. As well as there's also another this trend line resistance over here to take note as well. So about 710 to 715, there should be some considerable resistance for CT for now. Then price should do a pullback and probably trade in a range where the support is closer to about 680 to 690 for now. Okay, next one is DBS. Okay, for DBS, there's also price also broke down of a wedge over here for now. So there's some short-term weakness. Then we also, but price is currently finding some support at the previous swing low around close to the $31.90 level for now. So if price is able to hold over here, we should see some range bound pattern where the resistance is likely to be at 32.60 onwards to about $33. However, if price continues to break down this level, I think we could see continued weakness in DBS to retest the lows near the next lows, which is near 31.10, as well as $30.80 for a lower level of support. Yeah. So some recent share price weakness in the local bank and Agricultural Bank of China. For Agricultural Bank of China, I think a very strong bullish momentum recently. Price was trading in a 45-degree manner, and then we currently just have a melt up. For now, we also cleared the previous high resistance at 365, which was back in 2018. So I think for now, price I think could go higher, but with such a strong movement, price might have to consolidate a little bit first, given that we just smashed through the previous high in such a manner for now. Yeah. So, but overall, we are still quite bullish, but maybe just some little bit of a consolidation needed for more sustainable gains. Okay, next one will be some ASX counters, FLT Flight Center. Okay, so for Flight Center, recently price has been bullish. We have been making a higher high from 1980, and we also broke above this wedge resistance over here near $21. And then the 2130 level previously was a short-term resistance back in May of last year. So for now, if we are able to hold this $21 level, right, I think price will be able to retest closer to 2260, which was another resistance level back in April last year, and then another resistance will be at around close to 2340 level as well. So still bullish, but price needs to hold above this breakout for it to be valid. Okay, next one will be ANZ. Okay, for ANZ, I think currently still bearish, given that when we look at the main uptrend channel over here, price did a breakdown in March, and then we did a retest back in late April. Currently, we are still below the uptrend channel. So for now, I think looks like we have a higher low for now. So let's see whether price is able to build a range for now and try to re-enter the uptrend channel. The key resistance to break will probably be at 2460 over here. And then a current support, I think probably is from about these lows at 2290 to about 2360 over here. Yeah. Okay, next one, TA on STI. Okay, so for the index, I think currently we should be expecting some form of a little bit of weakness in the index, given that we are near the resistance zone, and this was following a run up from mid-March when we hit close to about below the 3100 level. So the strong resistance zone for STI is about at 3290 to about 3330 with this red color box over here. You can see recently the price action is that actually following a strong upward momentum over here, then price action start to sideways, and then we actually broke below these lows of 3280 over here. We actually broke below, and then we traded lower. So that's a little bit of a weakness setting for STI. So I think for now we should be able to continue to see a pullback. Maybe maybe price will probably trade in maybe this downtrend, maybe like a downtrend channel over here for now. Yeah, to consolidate some of these the recent gain. Okay, next will be C-Trium. So for C-Trium, I think price action is quite bullish recently. So we had a consolidation triangle breakout over here at over here. Okay, then this 13 cents level is also important. Price actually just sideways over here for now. And then you can see this was a previous support level of a head and shoulders pattern. So upon the retest, we expected some resistance, but actually following some news, price actually went further up. So for more continued strength, price has to remain above this 13 cents level. If not, this could be like a false break above. Then for now, I think the next resistance we could expect is from about 0.134, which was this support level over here that was broken, to about 0.137 for now. That should be the current resistance levels. Okay, next is Olam. So for Olam, I think currently price action wise, we are just still sideways trading consolidation following a recent rebound. So for now, the support is still likely to be at $1.52. The resistance is going to be at around 157, 158, so about 160. So I think for now that's not gonna change unless we see a break below this support of 152. Then we could see price going down maybe to 147, 148. Then we do see a breakup of 160. I think we could go up to about 163 to 166. Yeah, but shouldn't have much to look forward to unless we break these key supports and resistance levels. The next one is AIMS APAC REIT. I think AIMS APAC, we are currently trading in an uptrend channel over here. Then price action wise looks not bad recently. This key resistance at 138. We tested it multiple times. So today we are trading above it again. So if that is continued, I think we can test 142 to 144, which was the previous resistance zone back in 2021 over here, back in July to September. Yeah. Okay, then some of the Hong Kong counters, 3032 Housing Investment Management Tech ETF. I think for now it should be following the same pattern as HST ETF. So for now, I think we could expect a little bit of a range bound pattern. Price you can see for this has been holding at 375. So the current first level of resistance will be near $4 over here. Then we also have this downtrend resistance line acting on it as well. So there should be some resistance for now near $4. If you do see a breakout there, I think price could go closer to 420 over here. Okay, then next is Tencent. I think Tencent for now we should see a little bit of a range bound movement for now. This is because our price has been trending downwards recently, and then we are still despite some recent retest of the 350 level, we are still below it. So that previous support now is acting as resistance, but then we are seeing some support closer to about 330 to 335 over here. Given the two recent bounces over here near the previous the recent support formed in May. So price should be supported around here, but should find resistance closer to 350. I think that will continue. So some range bound action for 10 cents going ahead. Okay, then next will be JD. JD for now is starting to following the risk, the downwards movement, starting to trade a little bit more of a range. Still finding resistance near 143 with a recent two highs over here. 143 was a previous support over here. We can see that was being broken. So now it's acting as resistance. I think price will only start to turn up if it's able to break above this 143 level convincingly. For now, I think we should see price consolidate in a bit more of a range fashion. Some of support levels thing will be 133 over here, as well as 137 over here. Yeah. Then the next one will be Ping An Insurance. I think Ping An is one of the stronger tech stocks recently. Excuse me. So it has been very strong. It has traded above this trend line resistance over here at $59. Sorry. It's trading above this $59 trend line resistance over here, and also a previous horizontal resistance over here back in February. So I think if that is sustained, if its price action is sustained above $59, I think it could go to $62 next, which is another horizontal resistance over here. Then going further higher would be $65, which was another significant high back in January this year. Yeah. Yeah, I think for venture, now recently we are trending downwards. Then we also broke below this 1650 support level over here, but this was with the dividend over here. So these charts need to be adjusted. But given the recent price action, I think we could see maybe some further downward price action to retest the lows near 1570 to about $16, which was the lows near in October of last year. Yeah, given the recent bearish movement for venture. Okay, then for first resources, I think a bit similar to venture, we actually broke down below this trend line support over here with a price gap, but this was with the dividend. So I think currently we are retesting this previous support near 136 for now, and the next support level will probably be near to 128. So if the bearish momentum continues, I think we could see price retest this lower support. Then for next one is the best world. Okay, so for best world, I think for now price might be able to find some support near $2 and near the $2 mark. So this is because there's this channel support over here, as well as a previous horizontal resistance that broke out of near $2.05 over here. So there's a convergence of two supports over here, but for now, I think it will be a short-term rebound as we are still trading in this downtrend channel. Then the resistance will be closer to about $2.12 to about $2.14. $2.14 will be a previous swing low over here that we actually broke down off over here. And then we can take reference from this downtrend channel resistance over here as well. Okay, next one will be yen lot group. I think for yen lot, price should be able to trade in a range bound pattern for now. Looks like there's a possible double bottom being formed at the 84 cents mark. Resistance is at 93 cents level. So I think this is the trading range for now. Then looking at the indicator wise, I think MACD and RSI, there's some positive divergence taking place. The momentum is actually quite bullish in the range. So I do think that price will be able to bounce up to retest this resistance near 93 cents going ahead. Okay, then Prime US REIT. Okay, so for Prime, I think we are trading near the channel support over here near the 24 cents mark. So if that holds, price should be able to do a rebound, but looks like still not sure whether when the rebound will take place. Given that we are just trading lower lows for now, as well as lower highs over here recently. But looking at the indicator wise, right, we look at MACD, there's some bullish momentum taking place, bullish crossover, as well as the RSI will have higher lows taking place when the price action is having lower lows. So I think for this is if you're patient enough and you have some belief, I think price might turn up soon based on these indicators as well as because it's sitting near the channel support. Then the key resistance for now is likely to be at 28 cents to about 29 cents mark, which is the recent support levels that it broke down off. Then further up will be near to about 33 cents level over here. Okay, then for iREIT, I think currently nothing much. I think it's still retesting this trend line resistance at about 51 cents. Then we can see price action wise, we're just trading in a sideways direction. So for now, I think support is still near this 48.5 cents to 49 cents. Then resistance is likely to set in at 50.5 cents to about 51 cents. So I think we continue some range movement for iREIT. Then for Capital Pacific Oak, I think this one for now price is trending lower. Then we also broke below this recent support level at 35.5 cents. So with that, I think we could retest the low at 34 cents over here. If we're able to find some support, then I think we could trade in a range for now. Then the resistance will be closer to about 38.5 cents to about 39 cents region. So let's see what happens. If this support at 34 cents fails, then I think we could expect it to retest a lower level of support based on this trend line over here, which is tested multiple times. Okay, for the trail of local banks, I think just now I missed out on UOB. So UOB currently is also displaying some form of weakness, given that it's trending downwards after hitting the trend line resistance over here near 29.40. Then price is also below 28.50, which is this key horizontal level. So I think for now, probably some retest will take place. Then there could be some resistance setting in for now if it rejects off over here. But price is making a higher low over here if this low is supported at 27, close to 27.80. So if this holds, then I think price maybe just trade in a range over here. Okay, next one is digital core REIT. So I think for this is we can see price is near the support near 42 cents over here. Then the low here was at 40.5 cents. So I think it should be support coming in near these levels. Resistance wise, recently there's resistance formed at 44 cents, which is this support broken down and can expect some resistance over here. Coupled with the fact that this is also there's also this trend line resistance over here. So for now, I think some range bound trading for a DigiCore, if it's able to hold this support as well as these resistance levels. Yeah. Okay, next one is STEM industry. STEM industries is still very bullish. We actually are still above this uptrend channel over here, and recently we broke out this blue color ascending triangle pattern in the resistance at 433. So price is just going a very strong candle. Price is just consolidating sideways. So I think that will probably continue as price tries to consolidate a little bit first before we see the next move for STEM industry. Okay, then I'll probably go through two more counters before I hand the time back to my colleagues. For Franca, I think price is holding above this trendline support over here. Then we actually broke out recently of this downtrend channel or downtrend resistance line over here. So I think if the support over here is able to hold near the $1 mark, then I think price could try to break above this $1.03 to $1.04 level to try and retest $1.07, which was this previous support, and then previous support over here, which would now act as the resistance level. Okay, the last one will be AEM. Okay, AEM has been quite bullish recently. Price has traded above this uptrend, blue color uptrend channel. Then currently we hit about 337. Then we actually retesting this channel over here. So it is able to hold at 350 and price subsequently rebounds above this 358, this horizontal resistance over here previously. Then I think the bullish momentum can continue given that we're still making higher highs and higher lows over here in this spread. However, if we do, let's say we do break below this, right, and this could be a false breakout to take note of, then the next support level is probably near 340 over here. So that's it for my views for TA. I'll hand back my time to my colleagues for any other questions.
Okay, thanks. Sorry. Thanks, Dean. So I think there's no other questions that. Okay, this one, last one. Can you please comment on Asian Pay TV? Thank you. Yeah. So for Asian Pay TV, we dropped coverage, and that although they are earning like 10% dividend yield, and I think they can probably sustain it the next 1-2 years. The only but the risk for us and why we kind of drop our coverage is because there wasn't much interest, number one. Number two, it's going to be hard for us to talk about this stock when it's based out of Taiwan. So it's like an uphill task to convince people. And of course, there's also leverage on this stock. They are still protected until 2025. But even if because they fix their interest, their debt, the interest rate on their debt, mainly the Taiwan, their onshore Taiwan debt at probably around 1%. But the TIBOR, which is the Taiwan 3-month interbank market, is for some strange reason is still very low. It's only 1.5% now. So even though they might face higher interest rates, it's just going to be 50 basis points. But again, it's just a story that's very hard to convince investors that there's virtually not much interest in this stock. So that's the reason why. But the ability to pay the yield, their dividend yield, which is 1.05 cents or around 10% yield right now, I think that shouldn't be an issue for the next, I think, 1 to 2 years at least. Okay, Darren, I'm not sure you want to answer this one, Mapletree one. Yeah.
Yeah, the Mapletree Industrial Trust, there's a lease expiry end March. The tenant AT&T, yeah, that one is not released yet, so it's still outstanding as of the end of the FY. Yeah, so it's still outstanding. Yeah, I think that's all for me.
Okay. Max, I'm not sure if you can take on this. If the semiconductor industry in the West is stagnating, what about China's industry?
Yeah, unfortunately, I don't really follow the semiconductor industry in China, but from what I know is that they are quite positive last time, because of the US ban, right? Then they want to localize all their production. So they say that is kind of a tailwind for them. But other than that, I don't have really that much to comment on.
Yeah, I guess the only thing we can comment is that I mean, you build all this new capacity and you're not taking in demand from China, which is the biggest market. So I'm not sure who's going to fill out all these fabs. I know. Yeah, because the US is building a lot of fabs, but they said, oh, we're not selling to China. But China's one of the biggest, if not the biggest market for semiconductor. So I'm not sure what they're actually trying to do. But anyway, you might build all this, but then you might end up losing a lot of money. Again, I'm just saying I don't have the details here, but you're omitting your biggest one of the biggest customers in the world as you ramp up capacity. So it doesn't sound logical anyway. Yep. Okay. Thanks. I think we answered most of the questions. So thanks everyone. Thanks for taking the time to be with us here. Help everyone have a good week ahead. And also, thanks for all your questions. And do reach out to us if you have anything on our community chat. Yeah. Thanks everybody. Yeah. Take care and have a good week ahead. Bye bye.